Hey there, Steve Rubis with another installment of Capital Markets Investor Relations in 2 minutes or less. Today we're going to talk about what corporate debt prices can signal about underlying equity prices. And it starts with the premise that corporate debt prices indicate a lot about the health of an underlying company and its stock price. And what a debt price can actually signal is a significant valuation disconnect in the underlying shares. If the bonds are trading at or near par and the stock trades well below $10, there may be a valuation disconnect that's worth researching. And corporate debt actions like a refinance can serve to be a major catalyst to remove that disconnect and unlock shareholder value. And then finally, let's look at Transocean as an example of this in real life. So the best case scenario is when your debt is trading at or near par and the stock trades well below $10 in share price. This means that there's likely a valuation disconnect worth researching. And Transocean is in this situation. It's a very levered company. It's got $7 billion in debt on a $5 billion market cap, $13 billion enterprise value. The bonds trade near par, and the equity is trading well below $10 and started the year below 5. Now, the key debate, if you're a bear, you believe that the excess leverage means that Transocean is insolvent. But if you look at the debt prices and the recent debt actions around refinancing, it actually suggests that there's a valuation disconnect worth researching. So let's look at this key catalyst of a debt refinance for RIG and why it's so important. So they improved their debt stack in several ways, starting with moving from secured to unsecured debt. They've extended their duration from 2025 and 2027 to 2029 and 2031, moving repayment dates out into the future. Number 3, they improved the interest rate by nearly 2% at the midpoint. And number 4, they refinanced $1.5 billion that was upsized to $1.8 billion. And the key takeaway is this, that an insolvent company cannot refinance nearly 40% of its market cap at attractive terms and rates if it's insolvent. So there seems to be a valuation disconnect worth researching with Transocean. So what are the key learnings for corporate executives? The first is debt signals a lot about the health and valuation disconnects in the underlying equity of your business. Number 2, if you can improve the debt structure, terms, rates, this can be a major catalyst to solving that valuation disconnect and unlocking shareholder value. And then finally, always roll your debt when you can. Don't wait until you have to. You will pay a price in terms of rates and terms. Always here to help with your capital markets investor relations needs. Thanks for watching.